Real estate license exams for dummies. Part 5. You want how much? Validation and financing of real estate. In this chapter, understanding how real estate mortgages work, finding where to borrow money to buy real estate, checking out lenders' considerations for making loans, discovering different mortgages and how they are paid back, looking at consumer protection laws. Chapter 15. Finding the money. It's no secret that most people don't buy property for cash. They borrow money from banks, savings and loans associations, and other lending institutions so they can buy a house or investment property. Now, rather than waiting on saving up money, even the government helps by income taxes. Part of the real estate agent's work is dealing with advising buyers where they may be able to borrow money to buy property. Because all the variation types of mortgages and repayment plans, real estate agents also need to be familiar with the idea that when it comes to mortgages money, one size doesn't fit all. Although most cases, real estate agents ultimately refer buying to banks and other lending institutions or mortgage brokers to get the financing they need to purchase a house. Familiarity with many of the details of real estate financing is important to provide sound advice to buyers. This chapter takes a look at the basis of mortgage processes and sources of mortgage funding. I cover several considerations that lenders take into account when making the loan. You discover different kinds of mortgages and repayment plans, do a little mortgage math, and find out laws that require everyone to be treated fairly when it comes to borrowing mortgage money, even if they're 70 years old and want a 30-year mortgage. The way things work, mortgage basics. The basics to start a discussion about real estate financing is with some basic concepts and terminology. In this section, I cover the basic mortgage process, review some important terms, discussing several mortgage theories, and give you the scoop on conditions including in a mortgage after understanding how much real estate financing works and how to use some of the terms. Specific mortgage concepts will fit in pretty nicely. All the information probably will be covered in the exam, especially the definition and maybe a little math. The nuts and bolts of a mortgage process. A buyer and a seller agrees on a price and the other terms involving in the sale of a house. The buyer has some of the money in cash, say about 20% of the total price, for a down payment, but needs to borrow the rest. The buyer goes to the bank and other lending institutions to apply for a loan for the rest of the purchase price of the house. The lender considers two things when examining the buyer's application: the ability of the buyer to repay the loan, which includes factors like the buyer's credit and employment history, the value of real estate being purchased, which is usually determined by an appraisal, a topic that I discussed in chapter 14. Most work in the appraisal industry involves estimating property values for mortgage purposes. Because property is considered security for a loan, lenders want to be sure that the property can be sold to pay off the loan if necessary. We'll see considerations for loan acceptance mortgage later in this chapter for more. The lender issues what is known as a mortgage commitment, and on the day of the closing, that is when the title of the property changes hand. See chapter 9. The buyer also closes on a mortgage loan. Closing on a mortgage simply means entering into a final and formal agreement to accept the money and pay it back. The check from the bank is given to the seller, and a short term later, the buyer begins paying off the loan under the terms of the mortgage agreement. Liens, notes, and the mistake most people make. Although you may sign a whole bunch of papers at the closing, two important documents you'll sign as part of the mortgage process are the note and the mortgage. I explain these and some other terms associated with mortgage loans in this section. Definitions are important here for test purposes. The basic definition will guide you to understanding each of the terms, choosing the right answer on the exam. The process of using property as security for the loan is called Hypothecation. In real estate circles, the process is accomplished through the mortgage, which is a document prepared by a lender and signed by the borrower, and in closing, essentially serves as a voluntary lien on the price of real estate. Excuse me. Liens are financial obligations that are attached to real estate. Remember though, hypothecation, the owner of the property voluntarily places a specific, meaning the property only, lien on the property in favor of the lender without giving up possession of the property. When a mortgage is signed by the borrower, the property is committed as a security for the loan. A mortgage is signed by the borrower, the property is committed to as security for the loan. A mortgage lien enables the lender to sell the property after a foreclosure process to pay off the debt. If the borrower defaults or does not pay off the debt for more than what is included in the mortgage agreement, as common condition of the mortgage loan. Later in this chapter for more about liens in chapter 8. The second document that the borrower signs as part of the mortgage loan process is called a promissory note, or sometimes just a note. The promissory note is an agreement to repay the loan according to the terms and conditions. A trust deed is used in some locales to secure a mortgage loan. A trust deed is also called a deed of trust. For a deed of trust works, a third party must be involved. The trustor, the borrower, gives a deed to a trustee, the third party. The deed gives title to the property without the right to possess it. These types of titles sometimes is referred to as a bare or naked title. The trustee holds the deed until the loan is paid off. The property then is reconveyed back to the trustor. If the trustor, the lender, doesn't complete the terms of the loan, the trustee conveys the title to the property to the beneficiary, the lender, for the sale to satisfy the debt. For more about trust deeds, see chapter 9. Now that you know about mortgages and notes, allow me to clear up the common misuses of the words you just learned about. Mortgage, in fact, is a misuse. Is a comment that I hear real estate agents use in the wrong way. And in the meantime, you discover two other items, two important words related to mortgages that can get you in trouble on the exam. So you'll think the buyer goes to the bank and applies for a mortgage. Wrong. Well, then you'll say the bank gives the buyer a mortgage. Is wrong. So you simply say, I'm going to get a mortgage to buy a new house. Wrong again. Yes, wrong on all of these three accounts. And yet, those are the things most people say, including virtually everyone in the real estate business. While these commonly used phrases are wrong, and the right way to describe the process or focus on two words that absolutely need to be remembered. A mortgagor and a mortgagee. You go to the bank to borrow money. In return, the bank, you agree to give the bank a mortgage on the property. And remember, the mortgage is a voluntary lien that enables the bank to take the property and sell it. If you don't pay back what you borrowed, thus giving them the mortgage to the bank, you are the mortgagor. And because the banks accept the mortgage in return for lending you the money, is considered the mortgagee. Compare mortgagors and mortgagees in the words lessor and lessee in a lease situation. The lessor is the landlord. The landlord gives the lease to the tenant or the leasee. The things to remember that the words mortgagor and the mortgagee is that the borrower are mortgagors because they give the mortgage to the bank, which accepts them to give therefore as the mortgagees. And I tell my students that if you get one wrong on the exam, I come into their house and telling the neighbors on them. I have a theory on mortgage loans. The difference is how much mortgage loans affect property ownership are more theoretical than practical, and so they've been boiled down into 3 theories. And this list follows. You need to be sure to find out which of these theories your state follows. The lien theory. Under the lien theory, a mortgagor, the borrower, retains both the legal title and equitable title to the property. The mortgagee, the lender, is granted a lien on the property. Legal title is the title or ownership that normally transfers in a property sale. Equitable title, which is fully explained in Chapter 11, gives the holder of the equitable title to force the transfer of the title when all conditions of the contract are met. Under the lien theory, the mortgagee must go through the legal process of foreclosure to get legal title to the property to be able to sell it for non-payment of the debt. For more about foreclosures, see shutdown foreclosures later in this chapter. The title theory. The mortgagor gives legal title to the mortgagee but keeps equitable title. Because the mortgagee already has title, gaining possession of the property for sale to repay the debt is more direct than under the lien theory. And the intermediate theory. Based on the title theory, the borrower retains the title to the property and a mortgage is a lien. If the borrower defaults on a loan, the title is conveyed to the lender. Intermediate theory makes the mortgagee go through the foreclosure process before the property can be sold to repay the loan. Common conditions of a mortgage loan. Like any business arrangement, the term and conditions of a particular mortgage loan can differ from those of any other mortgage loan. But most mortgages loan arrangements have a number of terms and conditions in common, and some of them may show up in the exam. So I give you the definition and the explanation in this section that you may want to remember. A job or a few to-dos. Duties of the borrower. The typical mortgage loan, the borrower commits to a number of obligations that are written into the mortgage or note documents. These include paying off the debt under the conditions as specified in the note, which includes the interest rates and the payment schedules, indicating the property that the mortgagor, the borrower, is using as a security, paying all real estate taxes and property, getting permission from the lender before doing any major repairs, alterations, or demolitions, protecting the lender's interest by maintaining a property hazard insurance on the property in case the unforeseen damages occur, adequately maintaining the property. You don't do your duty. The acceleration clause. The mortgage loan agreement frequently includes stipulations that are known as acceleration clauses, which effectively protect the lender from a loan for which the borrower is in default. Default is a situation in which the borrower don't fulfill the obligations of the mortgage loan agreement. See the previous section. An acceleration clause takes effect when the buyer is declared in default. The acceleration clause enables the lender to require that the entire debt be paid immediately. Yep, you read that right. So you default on a $100,000 loan and you were going to pay off over 30 years and maybe due in full tomorrow. That is, if your mortgage agreement includes in the 30 acceleration clause. Remember, the word acceleration means to speed up, and that happens when the payment are sped up so that the entire amount is due immediately. Moral of the story, don't default. But just in case you do, you can't read about foreclosures in your endings. You didn't anticipate foreclosures, assumptions, and assignments later in this chapter. Point taken. Points on mortgage loans. The normal interest on most home loans is paid out over the life of the loan, but sometimes lenders charge additional interest at the beginning of the loan that is based on the amount of the loan. This additional interest is called points, or sometimes discount points. A point equals 1% of the loan amount. And that's something you don't want to forget, because In common math question, remember, and the point is not 1% of the sales price of the house, but the 1% of the loan amount. Unless, of course, the borrower is a usual position of being allowed to borrow the entire price of the property. A bank agrees to make a mortgage loan of $100,000 to a property buyer. The bank agrees to lower the normal annual interest rate in the condition that the buyer pays 2 points on the bank at closing. How much does the buyer have to pay in points? 100,000 times 0.02 equals 2,000. This additional prepayment interest usually results in a lower interest rate for the loan as it is paid up. For example, the lender may charge you only 7% rate with no points, but give you a 6.72% interest rate if you pay 1 point at the beginning of the loan. Throughout the life of the loan, lower rate, you pay about the same total amount in interest, but the monthly payments are slightly lower and yielding overall profitability of the mortgage as an investment stay appealing to the private lenders. Lenders often sell mortgages to investors to raise more money to make more mortgage loans. The combination of the interest that is paid along the way plus the points charged and the prepaid interest combine to form the annual percentage rate, APR, which is the real interest rate you're paying. When points are paid to lower the interest rate, it is called buy down. The buy down is applied to lower the interest rate at the life of the loan for a specific period of time, like the first year or two. Borrowers who use buy downs to lower the interest rate during a short term usually are anticipating larger income later on during the loan and repayment schedule. Builders of new homes may pay points to lower the interest rate for a few years to attract buyers to their development. When a seller pays this, it's usually referred to as a seller incentive. Points sometimes are used to calculate loan origination fees. A borrower may pay 1 or 2 points, 1 or 2% of the loan amount to the lender for the administrative charge associated with the loan. This payment, however, won't reduce the interest rate on the loan. The origination fees sometimes are paid to mortgage brokers, who are individuals who don't lend their own money but rather arrange the loan between the borrower and the lender. Points are sometimes paid to lock in interest rates for a period of time. Say interest rates look like they're going up. A borrower may want to assure himself that the interest rate in effect for the time he applied for the loan is the same rate effective at the closing. The bank usually charges a fee for this, sometimes using points to calculate how much to charge on the rate lock. In long account, escrow. An escrow account, which is required by most lenders, is an account held by the bank on behalf of the borrower that is used by the lender to pay the taxes and insurance on the property. The lender normally calculates a monthly payment that includes the mortgage payment and a portion of the annual taxes and insurance costs. This is the payment the borrower makes each month to the bank. The bank pays itself with the mortgage payment and accumulates a tax and insurance portion in the escrow account. Make an appropriate payment as they come due. You can check out some mortgage payment calculations in Comprehending Mortgage Repayment Plans later in this chapter. Tax liens are first in priority ahead of all other liens. See Chapter 8. That means that the property is sold for non-payment of the mortgage loan. The taxes are due on the property and the taxes get paid first. If not enough money is left over from the sale of payment of the mortgage loan, the lender can be stuck with the loss. To avoid the situation, the lender handles the payment of taxes, and because the lender also wants to make sure that the interests are protected in the event of a damage to the property, it also collects escrow money from the property owner to see that its borrower, homeowners, and mortgage insurance premiums are paid. When someone buys a piece of property with the mortgage loan, the lender may collect a substantial sum of money at the closing, establishing the escrow fund. You may see other terms on the exam which mean the same thing as escrow account, including reserve, impounds, and trust accounts. Examining sources and assurance for funding. One of the important pieces of information that real estate agents can provide a buyer is where to go for a mortgage loan. But oddly enough, it isn't something that exam writers ask questions about. Beyond distinguishing between the primary and secondary mortgage market, which is what I'm going to tell you about right here. The primary market is composed of the lenders who lend money to people who want to buy property. The primary market is where you go to get a mortgage loan. The secondary market is comprised of financial institutions in which banks sell the mortgages to get more money to lend to you. You can find out more about primary and secondary mortgage markets in the two sections that follow this one. So it's just to find some terms related to the primary and secondary markets so you can make some sense of the topics in the rest of the chapter, which exam writers do ask questions about. On a related note, I also cover different federal loan insurance programs and private loan mortgage insurance in this section. As you get into who provides the money for mortgage loans, you need to understand a few terms because they relate as much to where you get the money as they do to the terms of the loan itself. The terms I discuss relative to the mortgage loans: conventional, conforming, non-conforming. The term I discussed relative to mortgage is related to down payments, which the cash you put down to purchase the property, and the qualifying ratio that the bank uses, which are the amount of money they think you can afford to pay. The qualifying ratio the bank uses, which is the amount of money they think you can afford to pay for your mortgage loan. These terms further relate to whether the lender primary market can sell the mortgage to a secondary market. One note as you read in the section: the lender of the primary mortgage market is the same thing. Conventional loans. These loans meet certain guidelines that can be set by the lender but often comply with the standards set by Fannie Mae. In the secondary mortgage market, you can read about Fannie Mae in number 2, the secondary mortgage, later in this chapter. The general terms are the total amount of the loans won't exceed certain limits, and typically that the borrower can no more than 80% of the value of the property involved. Although higher limits are possible, conventional loans essentially are loans made within normal guidelines by lenders in the primary mortgage market. By the way, as far as I know, no such thing as an unconventional loan exists. Conforming loans. This loan meets the criteria for it to be sold in the secondary market. The way conforming loans are set has to be done with the amount of money the borrower can spend on monthly payments. I help you do a little math in comprehending mortgage repayments plan later in this chapter, so you can see how the number works with this concept. Non-conforming loans. Here, a loan that doesn't meet the criteria of a secondary mortgage market. These loans may be made by lenders under specific circumstances and may include extra requirements that the borrower must meet, but they can't be sold on the secondary mortgage market. How this works is that Fannie Mae, for example, sets the guidelines that a borrower can spend no more than 28% of his or her monthly income on a mortgage payment, taxes, and insurance. If the lender primary market chooses to lend the amount of money that requires the borrower to use 30% of his or her monthly income for those payments, the lender has just made a non-conforming loan and can't be sold to Fannie Mae. Secondary market. However, it may be sold to a private investor who buys mortgages for the income from the interest payments that are generated. Number 1. The primary mortgage market. The primary mortgage market, or sometimes referred to as the primary lender, is where consumers, you and I, go to borrow money to buy real estate. Although all these institutions make loans directly to the public, some specialize in large projects, commercial properties, and other residential properties. The list of typical primary lenders include the following: commercial banks and savings and loans associations. These lenders are sometimes collectively referred to as institutional lenders. These institutional lenders lend money for any of the purchases of a single-family house to a regional shopping center. These institutions are one of the principal places the average consumer goes to borrow money to buy a house. Credit unions. These institutions primarily use or orientated towards lending money to the average home buyer / consumer. Credit unions can be very popular for these types of loans depending on the amount of assets upon which they can rely and the interest rates they are charged. Insurance companies. These lenders tend to specialize in lending for large projects such as construction or purchases of a large office building or shopping centers. The average home buyer will borrow money for an insurance company to finance the purchase of the property. Investment groups. These groups are individuals or companies pool their money to make mortgage loans. They lend money for large real estate projects rather than individual buyers. Mortgage bank companies. These companies are set up by investors specifically to make mortgage loans. Unlike banks or credit unions, they don't generally offer other banking services. Pension funds. Pension fund managers may lend money from their funds assets for the construction of large real estate projects or purchases. Pension fund loans tend not to be made to individual home buyers. Mortgage brokers usually are considered to be part of the primary mortgage market. Even though they don't lend money directly for mortgages, a mortgage broker is similar to a real estate broker, except that instead of bringing a buyer and a seller together, a mortgage broker brings a borrower and a lender together. Be sure to check out the basic requirements for becoming a mortgage broker in your state. The key elements you're looking for are whether the licensing or registration is required with some state agencies, the state agency involved, and whether you must meet any financial, educational, or experience requirement under state laws. In the wake of the financial downturn in the housing market in 2008, states have tightened up their policies regarding mortgage brokers. Exam writers like to ask questions about whether the criteria to be a mortgage broker and what mortgage brokers do. Number 2, the secondary mortgage. Number 2, the secondary mortgage market. The Federal Reserve System, the Fed, is a key player in the financial market that affects the availability of money for real estate mortgage loans. The system is regulated by two factors that have direct effects on the money that's available for mortgage loans. They are the reserve requirements for banks, which is the requirement for the Feds impose on banks to maintain a specific amount of their assets as reserve funds and cash. The reserve funds may not be used for loans. By increasing or decreasing the amount of money needed for reserves, the Feds can control the level of money that is made available for mortgage loans. The discount rate, which is how the Feds control the flow of money, it sets and adjusts the discount rate, which is the rate of interest that a member bank charges each other for loans between banks. Whenever a discount rate is high, interest rates on consumer loans increase, and vice versa. The rate charged to a consumer impacts the way many people choose to borrow money for real estate purchases or refinancing, and how much they can afford to borrow. Banks and savings and loans associations get their money from you and me, their depositors. Insurance companies get it from premium consumers payments. Consumers pay. The investment groups get it from investors. Although it probably sounds pretty obvious, think about what happens when banks run out of money, or to be more precise, when their loans exceed their deposits. The secondary mortgage market, which buys loans from banks and other primary lending institutions, is created to prevent such a problem from happening. Although details of these transactions are fairly complicated, the essence really is pretty simple. A primary lender institutes collects packages or pools. They are all means the same thing. It's mortgage loans. These loans have values because the notes on which they are based are promises to repay specific amounts of principal and interest. Plus, they're backed by the mortgage that enables the lender to sell the properties if the debt is not repaid. The secondary mortgage lender pays the primary market lender for those mortgage loans, which provides new money for the bank to lend to yet another group of home buyers. After the loans are acquired by the secondary mortgage, the payments of the borrowers go to the secondary mortgage institution. However, the primary mortgage market institution frequently retains a fee for servicing the loan or collecting the monthly payments and sending them on to the secondary institution. The three major and one minor player in the secondary mortgage market are organizations that either are directly or indirectly associated with the federal government. The following list explains some of the major characteristics with which you need to be familiar with when being tested on information about secondary mortgages. Fannie Mae. The Federal National Mortgage Association, or Fannie Mae, is a privately owned corporation chartered by Congress. Fannie Mae sells stocks and bonds to raise money to buy conventional bank mortgage loans. Although Veterans Administration, the VA, and the Federal Housing Administration, the FHA, loan programs are mortgage insurance programs rather than direct loan payments. That ensures mortgage loans made by a lender. Fannie Mae does not deal with these types of mortgages in a secondary mortgage. Fannie Mae is a lending purchaser in mortgages in the secondary market. It generally sets limits on the specific amount of mortgage loans that it buys. Any loan above these limits is referred to as a jumbo loan. Ginnie Mae. The Government National Mortgage Association, or Ginnie Mae, is a government agency administered by the U.S. Department of Housing and Urban Development. Ginnie Mae provides investors with the opportunity to invest in mortgages by selling pass-through certificates to investors. With these certificates, principals and interest payments are paid to the investors as a return on their investment to the program. Ginnie Mae works primarily with Fannie Mae in the secondary mortgage activities. Don't be thrown on an exam with the words tandem or piggy bank associated with these two agencies. It means the same. It means they're working together. Freddie Mac. The Federal Housing Loan Mortgage Corporation, or Freddie Mac, is a privately owned corporation that also provides a secondary mortgage for mortgages. It sells bonds to raise money, to raise funds to purchase mostly conventional mortgages. Farmer Mac. The Federal Agriculture Mortgage Corporation, or Farmer Mac, serves as the secondary mortgage market for farm loans. You may want to remember that the names of these agencies is previously listed by associating female names. Fannie and Ginnie, mostly with the federal and VA loans, and the male names Freddie and Mac with conventional loans. See your uncle. SAM, that is, Federal Loan Insurance Programs. The federal government sponsors a few programs that offers insurance coverage for mortgage loans. The real estate exams may include a question or two about these programs, starting with the fact that they are loan insurance programs and not direct loan programs. The conventional loan usually must be accompanied by a down payment, frequently as much as 20% of the value of the property that's being purchased. The two reasons for the requirement of down payment are that it provides for a financial commitment on the part of the borrower. Buying the property isn't all about using the bank's money. Some of it has to be from you, the borrower too. A cushion between the bank and possibly declines in property value. When the values of the property declines, if the lender can't sell the property for its original appraised value in the foreclosure or lending losses. Suppose, however, that the lender is assured of getting back all the money that is loaned out for the property. Even if the lender lends 100% of the value of the property, wouldn't the lender be inclined to lend more money on the property relative to its value? Enter the federal government with insurance programs that guarantee that the bank will get back its money from the loan. So when borrowers don't have enough money to make the down payment required by the lender, they seek loans insured by the FHA or the VA. Some state-run government direct loan programs or loan guarantee programs may be operating in your state. If so, they may be fair game for questions on your state real estate licensing exam. At the very least, those questions may render to the state program as one of the potential answers to a multiple choice question. So check out your state's program. The Federal Housing Administration. The Federal Housing Administration, FHA, is an agency under supervision of the U.S. Department of Housing and Urban Development that insures loans made by primary lenders. Even though you may hear it referred to as FHA loan, FHA never directly makes any loans. The most commonly used FHA program is called 203B loan. Numbering refers to the section of the law that governs such loans. Here are a number of rules for this program, some of which you may see on the real estate exam. FHA loans are limited to owner-occupied 1 to 4 family houses. The buyer at closing pays a fee called the Mortgage Insurance Premium, IMP. The IMP is based on the percentage of the loan. The Federal Housing FHA approved appraiser must make an estimate of the property's value. Standard governs whether the conditions of the property in the neighborhood qualify for FHA assurance. FHA-backed loans have high loan-to-value (LTR) ratios. Down payments may be as low as 1.2% for a lower-priced house. For more about LTVs, check out the section Consideration for Lenders Accepting Mortgages later in this chapter. Upper end limits on property values are in effect, and they vary from the state to the next and from the area to the next within the state. Other borrowers may assume some FHA loans. The rules vary with the original date of the loan. Lenders may not charge a prepayment penalty. Prepayment penalties are explained in the open mortgage section later in this chapter. Lenders may charge discount points or additional fees for the loan. The payments for these fees may be negotiated between buyers and lenders. The Department of Veterans Affairs. The Department of Veterans Affairs provides loan guarantee programs for eligible veterans and their spouses. Eligible primary lenders make the loan, and VA guarantees all parts of their loan if a borrower defaults. Some of the important features of a VA guarantees are as follows. The VA sets the rules for eligibility. Generally, these eligibility of veterans of military services who serve during specific periods of time and their eligible spouses or widows. The loan may require little to no down payment. The loan guarantees covers other occupied 1 to 4 family houses, including mobile homes. A certificate of reasonable value (CRV) is required for the approved appraiser. The amount of the VA guarantees is based on the CRV. Although no dollar limits are set on the price of the home being purchased, the VA limits the amount of loan that a VA will guarantee. The borrower may pay the difference in cash. No prepayment penalties is permitted. VA-backed mortgages are assumable under certain conditions. A funding or originating fee is charged to the borrower to be paid to the VA. The Farm Service Agency, FSA. The Farm Service Agency, formerly the Farmers House Administration, Home Association, is an agency of the U.S. Department of Agriculture that sponsors programs targeted at agriculture and rural areas. It guarantees loans made by primary lenders and lending money directly to borrowers. A private matter. Private mortgage insurance. When making a mortgage loan that has a high loan to value, LTV. For more about LTV, revert to checking out the property value section later in this chapter. The lender is lending a large percentage of the value of the property. The borrower is making only a small down payment. In these circumstances, for the protection, the lender may require private mortgage insurance, PIM, which is insurance coverage that the borrower purchases that protects the lender. If the borrower defaults on paying the loan, the PIM usually can be dropped when the borrower equity in the property has increased to acceptable levels. Equity is the difference between the value of the property and all the debts attributed to the property. The term for PIM varies from lender to lender, and some states even established that laws require PIM. The federal government enacted a law for loans made after July 29, 1999 that requires that lenders must drop PIM if the borrower requests it when the borrower equity is raised to 20% or more. The law further requires that PIM be automatically dropped when borrower's equity reaches 22%. Private mortgage insurance is obtained from private mortgage insurance companies. Consideration for lenders in accepting mortgages. The primary lender has two considerations when it's making a loan for the purchase of refinancing of real estate: the value of the property and the borrower's ability to pay off the debt. In checking out the value of the property, lenders may want to assure that the borrower can't pay off their mortgage default. The lender, can sell the property and get back the money they borrowed, assuming the property value is a sufficient and guaranteed loan. And the lender wants to make sure that the borrower can make the monthly payments, including taxes and insurance, for the life of the loan. Checking out the property value. The value of the property has a direct effect on the amount of money the lender will lend to you. And you need to be prepared to do the math problems about the topics in exam. The percentage of value of the property that can be borrowed is called the loan to value ratio, the LTV. The amount that is set by the bank in a secondary mortgage market. See number 2, the secondary mortgage market, early in this chapter. The value of the property is based on appraisal. See chapter 14. In the event that the appraised value and selling price are different, the amount of money can be borrowed is based on lower of the two numbers. And yes, that means that you'll be paying more than the appraised value of the house. Your down payment will be higher than expected because you may enter a problem with the LTV calculations. Here are some examples. A property sells for $400,000. It is appraised at $400,000. The LTV ratio for this mortgage is 80%. How much money will the bank lend? What down payment is required? $400,000, the appraised value, times 0.8, 80% equals $320,000 mortgage amount. 400,000 minus $320,000 equals $80,000 down payment. Notice that after the $400,000 is calculated, I use the term appraised value and not sale price. The reason I did this is because the evidence set the problems, which shows that happens when the sales price and appraised values are different. The sales price of a house is $315,000. The appraised value is $300,000. If the bank offers an 80% LTV ratio, the down payment will be needed. $300,000, the appraised value, times 0.8 equals $240,000 mortgage amount. So 315 minus 240 equals $75,000. A final problem shows how to calculate the LTV if you're given the value and loan information. Say the bank will lend you $240,000 with a property value at $300,000. What is the LTV ratio? $240,000 divided by $300,000 equals 0.8% or 80%. Note that in this problem I use the appraised value to calculate the amount of the mortgage, and when I subtract the mortgage amount from the seller's price to find the down payment that is needed. In doing a problem like this, just take the numbers for what they are. Don't get hung up thinking about things like whether they'll try to renegotiate the price or maybe not buy the property at all. These types of questions are about understanding the LTV concept and using the value rather than the sales price to calculate the mortgage amount. And don't worry about if the value of the property on a state exam seems realistic to you. Remember, these are statewide exams. I've lived in 2 states where the prices of real estate vary wildly from one part of the state to the other. Examining the borrower's ability to pay. The second type of calculation involves determining how much a buyer can afford to pay for a mortgage loan. You need to understand some of the terminology and how it works. The lender uses a qualifying ratio to determine what a borrower can afford to pay for a mortgage loan. When using a qualifying ratio, you work backwards from the buyer's gross income, usually using monthly numbers for principal, interest, and taxes, and insurance expenses to arrive at what the buyer can afford to spend on housing every month. You need to know that the acronym used for the payment of principal, interest, taxes, and insurance is PITI. When lenders do affordability calculations, they use the PITI as the total monthly expenses for mortgage loan payment calculations. For example, a lender may say that a buyer can afford to pay 20% of his total gross income in monthly payments, principal, interest, taxes, and insurance expenses. This percentage is called the front-end ratio. The lender also establishes that the borrower monthly debt payment includes the PITI can't be greater than 36% of the borrower's total gross income. This percentage is called the back-end ratio. You may or may not find a qualifying ratio calculation question on exam, but calculating them is a service that real estate agents routinely provide for their customers and clients. And just in case you like to do your own calculation, here's an example. Say you have $96,000 a year. Using a fairly standard qualification ratio of 28% of the principal, interest, taxes, and insurance, the PITI, at 30% of total debt, how much can you afford to pay for the PITI per month? $96,000 times 0.28 equals $26,880. $26,880 divided by 12 equals 2,240 maximum PITI. Alternatively, you can do the calculation this way. 96,000 divided by 12 months equals 8,000. 8,000 times 0.28 equals 2,240. Now, where you ask, does the 36% back-end ratio come in? $96,000 times 0.36 equals 34,560. 34,560 divided by 12 equals 2,880 maximum total monthly payment, including the PTIMP. Together, the front end and back end ratios work in such a way that the borrower's PI, TI, and total debt have to fall below both criteria. So, for example, the borrower's total monthly long term usually is 12 months, and for like credit cards and car payment, debt payments without the PTI were $2,000 a month. The lender would allow the borrower to spend $880,000 or less on the PTI PI. On the other hand, if the borrower has no other debts, the lender still wouldn't allow the borrower to spend more than $2,240 on a PI TI. Whatever amount of money is available for the PI TI, the lender uses the amount to calculate how much a mortgage the borrower can afford to pay off. Grasping the difference between mortgages. Although a specific mortgage loan may not be available for every possible situation, even variations are around to cover most people's real estate needs. And although mortgage professionals can and will help your clients and customers, real estate agents nevertheless are expected to know about the type of loans that are available for particular situations. That expectation translates into exam questions, so pay attention to the purpose of the characteristics of the types of mortgages loans that I describe in the following sections, so you can pick out the one that answers the exam questions correctly. As particular matter, knowing this information can help you make recommendations to the buyer who may not realize his mortgage product, the different mortgage products out there that can help her buy the property and get the commission. And you can get the commission. Blanket mortgage. A blanket mortgage is a loan that covers more than one piece of property. It sometimes is used as financed as a subdivision development. See Chapter 8 for more about subdivisions. Say, for example, that the builder buys a 6 lot on which he plans to build a house and sell them. The lots are an already approved subdivision. The builder may want to use a blanket mortgage to finance the purchase because it usually comes with the partial release provision. Remember that a mortgage is a lien on the property. I also discussed liens in Chapter 8. A partial release is a provision that allows the lien to be removed separately from each parcel as it is sold to the buyer, and the bank is paid a portion of the loan amount. Construction loan. Construction loan is made to finance a construction project. Typically, cases is when someone who owns property hires a builder to build a house. Money from the loan is released to the builder at a certain point of the project process progresses. At the end of the project, the loan generally is converted to a conventional mortgage. Home equity loan. A home equity loan seeks to use the equity that a mortgagor has built up in a property, either in providing the property or for some other uses. Home equity is the difference between the value of the property and the debt attributed to the property. For example, say someone paid $200,000 for a house. 10 years later, the mortgage has appraised for $300,000. The mortgagor has $100,000 left to pay the mortgage. $300,000 minus $100,000 equals $200,000 equity. Home equity loans are granted with various terms and conditions. The most common type provides for either a flat amount of money to be taken out, or for a line of credit to be created. The borrower can withdraw money from the line of credit as needed. Sometimes the borrower funds can be paid back and whether withdrawn again, like a revolving fund. Home equity loans have become popular as an alternative to second mortgages, to which they are related. Open mortgage. Open mortgage is the mortgage loan that can be paid back at any time without repayment penalties. A repayment penalty is a fee that is charged by the lender whenever a mortgage is paid off early. That's the normal schedule. These fees can vary from a mortgage to another, from state to state. The next, you need to determine what, if any, laws your state has adopted regarding repayment penalties and conventional non-federal guaranteed mortgages. Some states have limits on the use of the prepayment penalties, so check it out. Open-end mortgages. An open-end mortgage is a loan that can be reopened and borrowed against after some of it has been paid down. For example, you can borrow $150,000 via a mortgage loan with an agreement in place that after you pay some of it down, you can borrow back up to $150,000 limit again. Package mortgage. A package mortgage is a loan that covers real estate and personal property being sold with the real estate. The buyer of the house in which the furniture is being included in a sale may want to apply for a package loan. For example, the loan can be used to purchase a furnished vacation home. Purchase money mortgage. The purchase money mortgage is a mortgage loan used to buy real estate. The term sometimes is used to mean the mortgage that a seller takes back as part of the sales price of the property. When a seller sells his property for $300,000, the buyer has $50,000 cash. Is approved for a $150,000 mortgage loan, but still falls $100,000 short. The seller can agree to take back a mortgage worth $100,000 to make the deal happen. In effect, the seller is extending $100,000 worth of credit to the buyer, which will be paid accordingly to the terms of a promissory note that the buyer signs with the seller. The mortgage is called a second mortgage and will be in a second position to be paid off if the property has to be foreclosed or sold for non-payment of the debt. Sometimes the second mortgage is referred to as a purchase money mortgage. State governments set rates for interest that can't be exceeded, called the usury rate. The seller's second mortgage may not be subject to the usury limits that are set by the state laws, so you need to verify the information in your state. Mortgages made by lenders, not sellers, are subject to these limits. However, if the interest rates are artificially low, the Internal Revenue Service, the IRS, may calculate inputted interest. The inputted interest rate is the interest rate that the IRS says should have been charged based on the market conditions. The IRS will increase the tax owed by the seller and lender accordingly, as though the seller had been charged a higher interest rate. Reverse mortgage. A reverse mortgage sometimes is called a reverse annuity loan. The loan enables a property owner to use the equity in the property. See home equity loans early in this chapter for more. Without selling the property, money may be paid out in a periodic payment, a lump sum, or a line of credit up to a certain amount of the homeowner's equity in the home. No payment is due on a loan while the owner still lives in the house. These loans often are used for income by senior citizens or fixed income with large amounts of equity in the houses. They're usually paid off by the sale of the property after the homeowner dies or moves out. Sales leaseback. A sales leaseback isn't actually a mortgage, but can be a source of project financing and means of obtaining the equity in the property. It traditionally is meant in any discussion about real estate financing. Usually used the commercial property institution. An owner occupied uses a sale leaseback to sell the building but agrees to maintain the building under a lease. The new owner has a tenant and his old owner has gotten his money out of the building for use. Shared equity mortgage. The shared equity mortgage allows for shares of the profit on a property to be given to someone else in return for helping purchase the property. A relative, investor, or lender institution may agree to provide funds for the down payment or help with the mortgage payment. In return, when the property is sold, a determined share of the profit is given to the person who provided the financial help. Temporary loan. A temporary loan is called interim financing, bridge loan, swing loan, or gap loan. Is used when funds are needed for short periods of time to complete the real estate transaction. A typical situation where a temporary loan may be used is when sellers is selling one house and plan to use the proceeds from the sale to buy another house. If the individual has to complete the purchase of the new house before the sale of the old house is completed, a temporary loan comes to the rescue. Money is borrowed just long enough to buy a new house and then paid off with the proceeds of the sale of the old house. Wraparound mortgage. A wraparound mortgage is a new mortgage that literally wraps around the old mortgage. A seller sells a property to a buyer, but the seller doesn't pay off an existing mortgage. The buyer gives a new, larger mortgage to the seller. This new mortgage includes the amount due on the original mortgage. The buyer makes payments on the new mortgage to the seller. The seller, in turn, makes payments to the old mortgage to the lender. The mortgage is used when the old mortgage won't be paid off at the time of the sale of the property. Comprehending mortgage repayment plans. One key way that loans vary is how they are paid back. Before I explain, I need to tell you about fixed and adjustable interest rates, which will make describing several different repayment plans and doing the math the exam writers want you to know a little easier. Pay careful attention to the terminology and definitions as I go through this material. And remember that what I'm telling you about here is the terms of the note that a borrower signs, even though most people refer to it as a mortgage. Put in the various payment plans, its perspectives mean I need to give you a quick variation of banking 101. A bank, any lender really, has no money of its own. People invest their money in savings accounts and other interest-bearing instruments like certificates of deposit, and they expect to receive a return on the yield from other investments. The bank, on the other hand, lends some money out and charges interest on a loan. Part of the interest payments to go to depositors, and part of it is used to operate the bank. Your former economics teacher may have made it sound more complicated because many rules, regulations, and economic conditions obviously affect banking more than I'm letting on. But the essence of a loan process is just that. The bank is acting as a middleman between depositors and borrowers. And when people borrow money through mortgage loans, they must pay back the principal, which is the amount they borrow, and the interest, which is the bank's charge you to use its depositors' money. The interest rates charged for mortgage loans vary with economic conditions, but they are often less than the interest rate on other types of loans. Mortgage loans, however, frequently are made for large sums of long periods of time. Because of the length of the time of the money is used, the total interest paid can be substantial. Depending on the interest rate and the length of the mortgage terms, they can even larger than the principal amount itself. As you go through the type of repayment plans, keep this in mind. The mortgage loan and the principal terms of the note aren't satisfied until the principal and interest are paid back to the lender. It's in your interest. Fixed and adjustable rates. For a long time, the only type of payment plan available to a borrower was a fixed interest that never changed throughout the life of the loan. As economic times changed, it became apparent that a more flexible approach would better serve both the borrower and the lender's needs. The particular terms and conditions of any mortgage loans are, of course, fixed by the lender within the parameters of the applicable laws, but some general descriptions apply to both types of payment plans. And that's what I give you here. Some basics that the exam writers want you to know. Fixed rate mortgages. A fixed rate is interest means that's throughout the life of the loan. The interest rate and the amount of the monthly mortgage payment do not change. That does not change, however, in an amortization loan. See the next section. The amount of the principal and interest in each monthly payment. The mortgage loan interest is charged on the unpaid balance of the principal, so it is paid off the principal each month. The amount of interest being charged actually declines, and because of the payment remaining the same, the amount of principal you pay off each month increases. For illustration purposes only, you say you borrow $200,000 in the 30-year mortgage loan. The amount of the interest rate is mooted for the purpose of this example. Your monthly payment when the loan turns out to be $1,330 for 360 months. That's 30 years at 12 months times 12 months. The first payment of the loan turns out to consist of $1,170 in interest and $160 in principal payment. The amount of interest is so high at this point because you're being charged interest on a entire $200,000 loan. And that also means that after you make your first payment, you still owe the bank $199,840, $200,000 minus the $160 principal payment. Because the principal has slightly reduced, the amount of interest owed with the second monthly is slightly less than the first month. And because the monthly payment remains the same, the amount of principal paid off is slightly more than the first month. And by the time the last payment rolls around 30 years later, the situation essentially will be almost reversed, with $170 applied to the principal and $160 applied towards the interest. Adjustable rate mortgages. An adjustable rate mortgage, or ARM, is a mortgage for which the interest rate is subject to change during the life of the loan. An ARM can be amortized straight or partially amortized loan. See the next section for these definitions. Although the specific terms of an ARM are contained in the note, you need to be familiar with the general features. The interest rate for the loan is tied to the index, a rate over which the lender has no control. A federal treasury bond rate or other federal rates of some sort frequently is used in the index. The borrower's interest rate then is calculated by adding a predetermined rate called the margin to the index. For example, if the index rate is 4% and the margin is 3%, the borrower rate is 7%. As the index changes, so does the borrower's rate. The borrower's rate at any point in the time of an ARM loan usually is subject to two limits that are called caps or ceilings included. The annual cap, which limits the amount that an ARM interest rate can be adjusted upwards in any given year. For example, if you start with a total rate of 4%, 1% index plus 3% margin, the annual cap of 2%, and the index goes up by 3% points, the resulting rate would be 7%, 3% margin plus 4% index. However, because the 2% ceiling and annual cap is in place, the interest rate can be increased by only 2% per year to maximize the total rate to 6% for that year. If the index increases beyond the annual cap in any given year, the additional increase usually can be carried over to the next year. The lifetime cap or ceiling, which limits the total upward adjustment that the lender can make the interest rate during the time of the loan, regardless of how high the index goes. Say, for example, you started out at a total rate of 4% and the lifetime cap is 5%. That means the highest the rate can ever be is 9%. Another condition of the loan to be aware of is when a loan adjusts. Some loans adjust every year, others less often. Also, some adjustable loans can be or automatically converted to fixed rate loans after specific periods of time. For example, 5 years. A payment cap also can be put in place in an ARM, meaning that even if the rate adjusts each of their maximum each year, if the resulting monthly payment increases to more than the specific amount, the payment cap keeps the payment within reasonable limits. In some cases, however, exercising the payment cap can lead to negative amortization, which means the loan balance increases by the amount owed but not paid. So if the adjustment in a particular year brings the payment up to $15,000 a month, $1,500 a month, and you have the payment cap of $1,400, you won't have to pay the higher payment. However, the extra $100 a month you're not paying may be added to the total balance you owe, in effect increasing your loan amount. Doing the math, amortized loans. The most popular type of loans that buyers use to purchase a home is an amortized loan or direct reduction loan. The primary feature of an amortized loan is that at the end of the loan terms, the period during which the bank has loaned you the money, the loan is completely paid off. In other words, the borrower has completely paid the interest and principal of the loan. Each payment you make, usually monthly, is made up of a principal and interest. See the earlier section, fixed rate mortgages. So that you owe the bank nothing at the end of the loan terms. When you have an amortized loan, making additional payments, principal payments, or converting the loan into bi-weekly payments rather than monthly payments usually is possible. In both cases, by reducing the principal at a more rapid rate, although the feature payment remains the same, the interest rate component decreases and the principal component increases, thus reducing the total amount of interest being paid over the life of the loan. And remember, you're always paying interest on the unpaid principal balance. Prepaying principal also reduces the length of time you'll be paying the mortgage. State laws also allow banks to impose a prepayment penalty on you for making early payments. You need to check out what states allow in terms of repayment penalties. The monthly payment can be looked up in mortgage tables, which show you amortization or payoff rates for various percentage interest rates over a variety of the loan terms in increments of 1,000 of a loan amount. You can also do this through various online mortgage payment calculations or calculators. Just do the search for mortgage calculators and take your pick. But if you want to know the amortization rate for $1,000 at 6% interest for a 25-year loan, you look it up in the table, and you'll discover that the factors of a $6.44 per month. The factor is the amount of money it takes per month to pay off principal and interest on a $1,000 loan over a period of 25 years. So if you're borrowing $150,000, you simply drop 3 zeros, the same as dividing by 1,000, and you'll get 150. Multiply that times the factor you're looking up to see what you'll get. 150 times 6.44 equals 966. The 966 from the equation is the monthly payment it takes to amortize a fixed rate loan, paying off principal and interest at the same time of $150,000 at 6% for 25 years. One other thing that you definitely need to note is that the mortgage loan interests always are quoted as annual basis, so the interest is a certain percentage a year. In the event that an example question wants to know the monthly rate, all you have to do is divide the annual rate by 12. Exam writers rely on a series of math problems to test your skills calculating different aspects of an amortization mortgage. Here are examples of the typical of these kinds of problems. Check out chapter 18 for more mortgage math, including ways to figure out annual and monthly interest payments. Finding the monthly payment when you're given a mortgage factor. You borrowed $200,000 for 30 years at the interest rate of 5%. The mortgage factor is $5.37. What is the monthly payment necessary to amortize this loan? $200,000 divided by 1,000 equals 200. $125 times 5.37 equals 1,074. Remember that the mortgage factor is the amount of money needed on a monthly basis to amortize or pay off the principal and interest on $1,000 loan at a given interest rate over a given period of time. In the example, 5.37 is often written without the dollar sign. An amount needed to pay off a $1,000 loan at 5% for 30 years, but because you're borrowing $200,000, you have to divide by 1,000 to find out how many units of 1,000 are in the loan amount. Multiplying this amount by the factors giving you the answer. See how much the first month interest is. You borrow $150,000 for 25 years at 4% interest in an amortization loan. How much interest do you pay in the first month of the loan? Number one, $150,000 times 0.04, 4% equals $6,000 first year's interest. 6,000 divided by 12 equals 500 first month's interest. Remember that you're always paying interest on the unpaid balance of the loan, and the interest rate always are quoted on an annual basis. So the first month you're paying interest on the entire unpaid balance of $150,000 at 4% interest. The first calculation gives you the total interest for the year. The second one gives you the first month's interest. Note the calculation works only for the first month, because after that you've paid off a portion of the principal, so now you're paying interest on the lower principal. Finding the principal balance owed after the first payment. I use the same numbers as I did in the last example, so you can see how the problem can have an additional component if you're given additional information. You borrow $150,000 for 25 years at 4% in an amortized loan. The monthly payment is $792. How much of the principal do you owe after you made the first payment? Number one, $150,000 times 0.04, 4% equals $6,000 the first year interest. Number two, $6,000 divided by 12 equals 500 first month's interest. Number three, $792, the principal and interest payment minus 500 in interest equals $292 of principal. So number four, $150,000 original principal minus $292 first month's principal equals $149,708 principal owed after the first month's payment. In step one, you find the total interest due for 1 year. Remember, the mortgage rate is an annual rate. In step two, you'll find the first month's interest is divided by 12. In case you wondering, the first step works only for the first month in any 12-month period. In step three, you'll find out how much principal is contained in the first month's payment. You'll be given a total monthly payment, which is made up of the principal and interest. If you take away the interest, you'll be left with the payment of the principal you're paying for the month. In step four, you subtract the first month's principal from the original amount of the loan, and you're left with the remaining balance of the principal. Finding the total interest of the loan. Another type of exam problems that sometimes give people a hard time is calculating the total interest paid over the life of the loan. You borrow $200,000 for 30 years at 4% interest. It is an amortized loan, and your monthly payments are $954.83. How much interest will you pay over the life of the loan? Number one, 954 times 0.83 times 360, 12 months at 30 years equals $343,738.80. Total payments of principal and interest over the life of the loan. Okay, $343,738.80 total principal and interest minus the $200,000 loan principal equals $143,738.80 interest over the life of the loan. If you took a minute and tried to do this problem before you looked at the answer, you'll be tried somehow to use a 4% interest rate. Almost everybody does, but it's useless information in this problem because already giving you the monthly payment amount. In step 1, you calculate everything you pay over the life of the loan. In step 2, you subtract the principal from the total of what you pay. Remember that your payments you make up each month, and therefore a total of the payments you make, both principal and interest. So you subtract the principal that you have left in the interest. On a straight and narrow, straight loans. A straight loan is also called a term loan. Calls for the payment of interest only during the term of the loan. At the end of the period of the loan, a single payment of the principal is required. So you borrowed $300,000 to buy a commercial property on a straight loan at 5% interest. With a term of 20 years, you pay $15,000, $300,000 times 0.05. The interest each year for 20 years. At the end of 20 years, you'll have to make a single payment to the bank of $300,000, which pays the principal. These loans are used more often for commercial properties than for residential properties and may be fixed rate or adjustable rate. See Comprehending Mortgage Repayment Plans early in this chapter for more about repayment plans. Commercial property owners who sometimes sell their property after 5 years or 10 years may want this type of mortgage because they're unlikely the homeowner. They're not necessarily interested in paying off the property. A good mix. Partial amortized loan. Partial amortized loans are combinations of amortized loans and straight loans. See the 2 previous sections. Unlike a straight loan, a portion of each monthly payment of a partially amortized loan goes towards reducing the principal and towards paying interest. However, at the end of the loan terms, unlike the fully amortized loan, some unpaid principal remains. This amount is paid off in a single payment called the balloon payment. These loans may have interest rates that are either fixed or adjustable and are more typical used for non-residential purchases, but nonetheless can be used to buy a house. Fast Times Growing Equity Mortgage. A growing equity mortgage, or GEM, uses a fixed interest rate, but payments of the principal increases more than normal amortized over time. As such, the type of repayment plan enables the borrower to pay off the loan faster. The GEM loan, sometimes is called a rapid payoff mortgage, which you shouldn't confuse with the bi-weekly payment plan or making extra principal payments. I discussed both of those in a section during the math amortized loans early in this chapter. The GEM has a scheduled increase in principal payments that may, for example, be tied to the borrower's expectation of increasing income during the life of the loan. Endings you didn't anticipate: foreclosures, assumptions, and assignments. There's lots of good news in owning real estate. Unfortunately, there can be some bad news too. It's usually associated with what happens when you can't pay. The lender takes the property in a foreclosure. In addition, assumption and assignments involve new parties in a mortgage. The main thing to remember about these 3 things for the exam are the difference among them and a few of the main characteristics of each. Shutdown, foreclosures. When borrowers default on a loan, the lender may have to institute foreclosure proceedings. Foreclosures is the process by which the lender takes over ownership of the property and sells it for non-payment of the debt. Mortgages may contain an acceleration clause that enables the lender to declare the entire balance due after the borrower is declared in default. The number of missed payments that result in the default is set by the bank. Declaring a loan due in full makes foreclosure process easier. Because the entire debt is due right away, it must be satisfied by sale of the property unless, of course, a borrower wins the lottery and pays off the loan. Any funds left after all the debts associated with the property are paid go to the borrower. If the state has a Homestead Act in place, the borrower may be entitled to a certain amount of money, the rest going to pay unsecured debts like credit card bills. See if your state has a Homestead Act in place and what its provisions are. Foreclosures can occur in one of the several ways. Jurisdictional foreclosure, which is where the courts order properties to be sold as a result of a foreclosure action brought by the lender. This type of foreclosure is the most common, and you can remember it by relating the word judge as a jurisdictional. Non-jurisdictional foreclosures, which only means state permits, which only some states permit, can apply to both deed of trust situations and mortgage loans. You can read about deeds and trusts early in this chapter, and liens, notes, and mistakes most people make. Non-jurisdictional foreclosures involve filing a notice of default in the county recorder's office and providing appropriate public notice, usually through the newspaper. After that, the property is sold to pay off debt. Strict foreclosure, which is an action that's permitted in some states that requires that the appropriate notice be given to the borrower in a period of time established by the courts, during which the borrower may pay off the debt. If the borrower fails to meet the deadline, title to the property transfers to the lender. In this case, the selling property isn't specifically required by the courts. Many people mistakenly believe that whenever the lender forecloses on a property for non-payment of the loan, the borrower automatically is off the hook. If, however, the lender can't sell the property at the price that covers the entire debt, the lender can go to court and sue the borrower for the remainder of the debt. If the lender's suit is successful, the court enters a deficiency judgment against the borrower, who must then cover the portion of the mortgage loan debt that the property sale didn't cover. In the case of VA and FHA unsecured loans, you may not be true because insurance is in place to pay off the loan. In the event of a default for non-payment of the debt, depending on the state, the borrower may have the right to equitable redemption. A right to exist before a foreclosure, but before the sale of the property. During a specific time frame, the borrower may pay off the debt and reclaim the property. In other states, other similar time frames in effect just after the sale. During that time, the borrower can pay the debt and reclaim ownership of the property. The right to redeem the property after the sale is called statutory right of redemption. Sometimes a borrower voluntarily signs the property over to a lender by executing a deed to avoid a foreclosure auction. This deed in lieu of foreclosure or friendly foreclosure has a major downside from the lender's point of view. In a regular foreclosure auction, all junior or subordinate liens or liens on the property that are paid after the mortgage lien effectively disappear. However, in deed in lieu of foreclosure, junior liens remain in place and can become responsibility of the next buyer. To make matters worse, the lender usually also loses the rights to FHA, VA, or private mortgage insurance. See the section See Your Uncle Sam, that is Federal Loan Interest Programs, early in this chapter for more about VA and FHA loan guarantees and private mortgage insurance. The deed in lieu of foreclosure is not a particular type of deed. See Chapter 9 for more about deeds. Rather is whatever type of deed to which the borrower and the lender agree. When the existing mortgage loan on the property is not being paid off and the lender is making a new loan on the property, the lender will require the first lender to execute a subordinate agreement to protect itself from another mortgage lien holder. This allows a new loan to move into first position for payment if a foreclosure becomes necessary. For example, real estate agents sometimes refer to the bank of mom, that's your mother, lending you $100,000 to buy a house. You giving her a mortgage to secure the loan. Later on, the value of the house increases to $200,000. You want to borrow $100,000 from the bank to do some work on the house. The bank probably will make you get your mother to sign a subordinate agreement, that is to make you default on the payment and the bank forecloses the property and sells it, the bank will get paid first, and then your mother. Sometimes the bank simply increases the total loan amount to cover the new loan, plus pay off the old loan, so that once again the bank is in first position to be paid in the event of a foreclosure. Who owes whom? Assumptions and assignments. A mortgage assumption takes place when a new party takes over the obligations of another person's mortgage debt, and it usually requires the approval of the lender. A typical situation in which someone may assume a mortgage is when a buyer buys a house from a seller who has a mortgage loan at a much lower interest rate than the current available to the buyer. The buyer pays the seller the difference between the sale price of the outstanding balance of the seller's mortgage, which the buyer is assuming, either in cash or with a new mortgage. By assuming the old mortgage, the buyer also agrees to take over the payments on the remaining balance due. When buying a property, you need to recognize the important distinctions between taking over someone else's mortgage loan obligation by assuming a mortgage and by purchasing the property subject to the mortgage. This distinction makes a difference if you're during a foreclosure. Not enough money to raise from the sale of the property to cover the debt. If a property is purchased with the buyer assuming the mortgage, the buyer becomes personally liable for the portion of the debt not covered by the foreclosure sale. Say I buy a house for $200,000, paying the seller $100,000 cash and assuming the mortgage on their $100,000 left to pay. I lose my job, can't pay my mortgage, and have to make matters worse, the real estate values have plummeted. The lender forecloses and can sell the house for only $90,000. The lender holds me personally responsible for the remaining $10,000 of the mortgage debt that the sale of the house didn't cover. If the property has been bought subject to the mortgage, then the buyer is not personally responsible for the remainder of the debt owed by the seller. In some cases, the original owners may be liable. Say I buy a house for $200,000 with $100,000 cash for the seller, subject to the seller's mortgage, which has unpaid balance of $100,000. I lose my job, and on top of that, the real estate values take a non-sedative values take a nosedive. Okay. So I lose my job, and on top of the real estate values take a nosedive. The lender forecloses, and because the lower real estate values can sell the property for only $90,000, the lender can't hold me responsible for the $10,000 not paid by the foreclosure sale. When someone is assuming a mortgage or paying off a mortgage early, the borrower's mortgagor asks for a certificate from the mortgage stating the amount that currently is due on a loan so that they know exactly how much is due on a loan. The statement is called estoppel certificate or reduction certificate. An alienation clause in a mortgage loan agreement helps lenders prevent or control future assumptions of the mortgage loan by a new borrower. An alienation clause, which is also known as a due on sale clause, call clause, or resale clause, requires the borrower to pay off the loan in full immediately upon sale of property. Instead of requiring immediate payment in full, the lender can permit the new buyer to assume the mortgage. If the original mortgage loan interest rate is lower than the current market rate for the type of loan being sought, the lender may grant permission to assume the loan only at a rate closer to the market levels. An assignment of a mortgage is the change of the person or institution to whom the debt is owed on the mortgage without claiming the terms of the loan. An assignee, the new debt holder, is entitled to payments of the debt just like the original lender was. It was confusing. Remember that the assignment involves a change in the mortgage, that is, the lender. The assumption involves a change of the mortgagor, the borrower. Being fair, consumer protection laws. As the government passed laws eliminating discrimination in housing, it also looked at discrimination in financial real estate purchases. Likewise, it also passes consumer protection laws designed to inform consumers just what they're getting into when borrowing money. In this section, I explain these fair lending and consumer protection laws. Get to know the names of these laws and what they cover, and get through the exam questions. Also, don't forget to check out Chapter 9 for information about Real Estate Settlements and Procedures Act, RESPA. The Community Reinvestment Act. In 1977, the federal government passed the Community Reinvestment Act, CRA. This legislation requires banks to address the financial needs of the communities where they are located by making funds available for mortgages and other types of consumer loans to people within their service areas, and to make periodic reports indicating activities that were undertaken with respect to providing loan opportunities to residents in that area. Equal Credit Opportunity Act. The Equal Credit Opportunity Act, the ECOA, enacted in 1975, prohibits the discrimination in granting or arranging, for example, a mortgage broker of credit. Lenders are prohibited from discriminating on the basis of age, must be of legal age, color, dependency on public assistance, maternal status, national origin, race, religion, and sex. The Act further requires that people who are not granted a loan must be given a reason why they're turned down. It also prohibits discrimination against an applicant who may have used the rights under the Consumer Credit Protection Act, usually the Truth in Lending Act, which you can read about later in this section. The National Affordable Housing Act. The National Affordable Housing Act requires that a borrower must be notified when the servicing of their loan is transferred to another institution. Borrowers must be notified of the transfer at least 15 days before it becomes effective. The Truth in Lending Act. The Truth in Lending Act is a popular name for the Federal Consumer Credit Protection Act. This act was implemented by Regulation Z of the Federal Reserve Board. In practice, these three names are used interchangeably when referring to this piece of consumer protection legislation. The legislation applies to all real estate credit transactions for personal, home, or agricultural purposes, but not for commercial properties. The primary purpose of this act is to require that creditors provide information to consumers so they can make informed decisions about the use of credit in real estate transactions. Creditors are defined in the Act as people or institutions that make more than 25 loans per year or provide credit more than 5 times a year if loans use real estate as security. The Act provides for what is referred to as a 3-day right of rescission in most consumer credit transactions. This right enables consumers to change their mind within 3 days after closing on a loan. This right does not, however, apply to purchase money mortgages, first mortgages, or deeds and trust loans. You read about these types of loans in detail earlier in the section, grasping a different type of mortgages. But there are loans that are used to buy property. Refinancing loans, such as home equity loans, are covered by the rescission provision of Regulation Z. Advertising of real estate financing is heavily regulated by this act. If details about financing are presented in an ad, then the annual percentage rate, APR, must be stated. You must read more about APRs in the section Point Taken, Points on Mortgage Loans, early in this chapter. In addition, if the advertisement mentions any trigger terms, then additional legislation kicks in that requires more detailed information to be included in the ad. The trigger terms are the following: amount of any payments, such as monthly mortgage payment, dollar amount of finance charge, that is the interest rate, down payment, number of payments, terms of the loan, that is how long will the loan for. If any trigger terms are mentioned in the ad, then it also must contain the following information: annual percentage rate, APR, cash price, amount of the loan, down payment necessary, number, amount, and due dates of all payments, total of all payments to be made. The penalties for violating Regulation Z range from penalties paid to the consumer based on the financing charge to fine up to $10,000 per day and jail time up to a year. A few of the provisions of the Truth in Lending Act has been contained with provisions to the Real Estate Settlement and Procedures Act to further protect consumers who obtain mortgages. Chapter 9 discusses it in greater depth. And that was Part 5. You want how much? Validation and financing of real estate. Chapter 15, finding the money, mortgages. Thank you very much.